to a massive paradox right at the heart of what's shaping up to be the largest initial public offering in human history, the SpaceX IPO. There's this huge, almost unbelievable gap between how the public sees this company and the actual financial reality under the hood. And the craziest part? The mechanics of how this thing is actually coming to the market could end up affecting literally anyone with a standard retirement account. So let's get into it.
$1.75 trillion. That is the reported target valuation for SpaceX. Just let that number sink in for a second. To put that kind of astronomical price tag into perspective, at that valuation, the company would be worth more than literally every American defense contractor combined. We're talking more than the market caps of Coca-Cola, McDonald's, Disney, Nike, and Starbucks all rolled into one giant number.
But okay, here's where the cognitive dissonance hits you like a freight train. Despite that staggering, record-breaking $1.75 trillion valuation, the source data actually reveals that the consolidated SpaceX company lost nearly $5 billion last year. Yeah, you heard that right. $5 billion in the red.
So naturally, this brings us to the big flashing neon question raised by the financial analysis. Who exactly is stepping up to buy a company that's bleeding $5 billion a year, at the highest valuation in market history? Well, to figure that out, we have to look past all the flashy rocket launches and understand what is actually up for sale here.
Part 1. 3 companies in 1. Unpacking the business model.
Okay, let's dive into this. To make any sense of that sky-high valuation, we kind of have to dismantle this illusion of SpaceX as just a space exploration company. It's really more like 3 completely different businesses stacked on top of each other. While the rockets get all the media hype, they definitely aren't the main driver of the business. Out of their $18.5 billion in total revenue, rockets only account for about 21%. The actual crown jewel here? That's Starlink, pulling in a massive 61% of the revenue. And that remaining slice, well, that largely belongs to their newly acquired AI division, xAI.
And Starlink isn't just generating the most cash, its financial efficiency is honestly off the charts. Just 2 years ago, Starlink's profit margins were sitting around 41%. This year, they've skyrocketed to 63%. That rapid margin expansion basically makes it the fastest scaling telecom company in human history, easily servicing maritime, aviation, and defense sectors right alongside millions of everyday consumers.
But things get really interesting and frankly a bit weird when we pivot over to xAI. So SpaceX acquired xAI in an all-stock deal that valued the lab at $250 billion. Let's look at its industry peers for a second to ground this. OpenAI brings in an estimated $24 billion annually and is valued at $850 billion. Anthropic generates over $30 billion and sits at a $400 billion valuation. Then you have xAI, pulling in an estimated $1 billion in revenue, but commanding a $250 billion price tag. That valuation is just completely divorced from its revenue reality.
Now, what's really interesting about this is the operational reality of xAI is even messier. The analysis points out that this division is burning through over $1 billion every single month. On top of that, by March of this year, all 11 original co-founders had literally walked out the door. The CEO even came out publicly and admitted the platform needs to be rebuilt from the foundations up. The source material actually makes a pretty funny but super accurate comparison, calling xAI a reverse Jerome Powell, because instead of printing cash, it just sets fire to whatever cash the rest of the business manages to generate.
So if we map out the net financial reality, here is what the whole shebang looks like. Starlink and the rocket side of things are actually incredibly healthy, bringing in roughly $8 billion in profits. That's fantastic, right? Well, those massive gains were completely wiped out by xAI's staggering cash burn. And that right there is exactly what dragged the whole consolidated company down to that $5 billion net loss last year.
Part 2. Rewriting the rules. NASDAQ's convenient timing.
All right, so we've got a handle on the internal business operations. But how on earth does a consolidated, unprofitable company go public at a record-breaking size? Well, it turns out by utilizing a set of highly convenient rule changes recently adopted by the NASDAQ. Historically, a newly listed company had to go through a standard 3-month waiting period before it could be added to the prestigious NASDAQ 100 index, to give the market time to actually discover a fair price. But under this new fast entry rule, that timeline is compressed down to a mere 15 trading days. And this brilliantly illustrates how they've rushed the process to get automatic index fund demand flowing in just 3 weeks after the IPO.
Then there's the second big change, which involves the minimum free float. Basically, that's the percentage of shares actually available for you and me, the public, to buy and sell. Under the old rules, you needed a strict minimum of 10%,
But under the new rules, that minimum is just gone. Poof. This is an absolutely crucial detail because SpaceX is reportedly targeting a free float of just 4 to 5%. And to be clear, under the rules that existed just 6 months ago, that exact structure would have been an automatic disqualification.
But okay, the most mind-bending regulatory shift has to be this hidden multiplier. For companies with a free float under 20%, NASDAQ is now treating that float as if it were 3 times larger than it actually is in reality. So think about that. SpaceX's targeted 4% float legally gets weighted as a 12% float. The source analysis points out that this little trick legally manufactures artificial demand from exchange-traded funds, or ETFs, essentially forcing them to treat the available stock as way larger than it actually is.
Part 3. The forced buyer. Manufactured demand.
So you might be wondering, what does this all mean for me? Why do these highly technical, kind of distant regulatory changes matter to us? Well, because they are directly targeting everyday retirement accounts. To put the final piece of this puzzle together, we have to talk about passive index funds. These are investment vehicles that just track an index, like the NASDAQ 100. By their very design, they are mechanically forced to automatically buy the stocks included in that index. It completely bypasses your individual choice as an investor. Right now, there are over 200 investment products out there holding over $600 billion in assets that will be automatically forced by these new rules to absorb this stock at its peak valuation.
And that brings us to this highly unusual target, a 30% retail allocation. Just for some context, most IPOs allocate maybe 5 to 10% to everyday retail investors. SpaceX executives have tried to justify this massive 30% dump by saying they just want to reward loyal retail buyers who've supported them over the years. But, as you'll see, financial analysts are viewing this entirely differently.
The source material actually delivers this incredibly stark summary from portfolio manager George Noble. He says, your 401k is the exit liquidity. That's a pretty heavy statement. The analysis suggests that the buyers and the sellers aren't exactly showing up to the party at the same time. The mechanics behind these rule changes mean that passive funds and everyday retail investors are basically forced in early to absorb the stock at a peak valuation. And what does that do? It ultimately allows insiders who are sitting on big piles of low-cost shares to unlock those shares and sell them later on to that manufactured demand.
Which brings us to a pretty profound paradox to close out our explainer today. For years, passive investing has been sold to us as the ultimate low-fee, sensible, super diversified wealth-building strategy. But you really have to ask yourself, does the convenience of that set-it-and-forget-it index fund strategy actually make you a guaranteed automatic buyer for manufactured demand? It's a hidden cost of convenience that is absolutely worth reflecting on as we sit back and watch the largest IPO in human history unfold. Thanks for exploring this with me.